Madayaw, I am Benedict, and this presentation will be all about the capital budgeting techniques. So our objectives for this presentation is, of course, first, we will define what is capital budgeting, and we will know how capital budgeting works, and then we will define the techniques to be used for capital budgeting, and we will provide computation for these capital budgeting techniques, and we will also differentiate the capital budgeting techniques that we will be discussing. So I hope this presentation will be informative, and let's get started. So what really is capital budgeting? So capital investments are long-term investments in which the assets involved have useful lives of multiple years. So for example, constructing a new production facility and investing in machinery and equipment are capital investments. So capital budgeting is a method of estimating the financial viability of the capital investment over the life of the investment. So, unlike some other types of investment analysis, capital budgeting focuses on cash flows rather than the profits. So, capital budgeting involves identifying the cash inflows and the cash outflows rather than the accounting revenues and expenses flowing from the investments. So, for example, in non-expense items like debt principal payments are included in the capital budgeting because they are cash flows transactions. So conversely, non-cash expenses like depreciation are not included in the capital budgeting because they are not cash transactions. So instead, the cash flow expenditure associated with the actual purchase and or financing of a capital asset are included in the analysis. So over the long run, capital budgeting and conventional profit loss analysis will lend to similar net values. However, capital budgeting methods include adjustments for the time value of the money. So we have said that capital budgeting is used by companies to evaluate major projects and investments such as new plants or equipments. And that capital budgeting involves analyzing a project cash inflows and outflows to determine whether the expected return meets a set benchmark. So how does capital budgeting really works? So when a firm is presented with a capital budgeting decision, one of its first tasks is to determine whether or not the project will prove to be profitable. So how will we prove that? Uh, we we will first identify the long-term goals of the individual or the business. We will identify the potential investment proposals for meeting the long-term goals. We will estimate and analyze the relevant cash flows of the investment proposals. We will determine the financial stability of each investment proposals. We will choose the project to implement from among the investment proposals. We will then implement the projects chosen. And of course, we will be monitoring the project or the projects implemented. So, it is said that a capital budgeting decision is both financial commitment and an investment. So, by taking on a project, the business is making a financial commitment, but it is also investing in its long term direction that will likely have an influence on the future projects of the company or will the company consider future projects. So, there are several capital budgeting analysis methods that can be used to determine the economic feasibility of a capital investments. So, these are the capital budgeting techniques that we will be discussing. We have the payback period, the discounted payback period, the net present value, the internal rate of return, and the modified internal rate of return. So the first method that we will be discussing is the payback period. So a simple payback period is the most common method that is used for capital budgeting. So it represents the amount of time required for the cash flows generated by the investment to repay the cost of the original investment. So, for example, let's assume that an investment of around 600,000 pesos will generate an annual cash flows of around 100,000 pesos per year for 10 years. So, the number of years required to recoup the investment is 6 years. So, the payback period analysis provides insight into the liquidity of the investment or the length of time until the investment funds are recovered. However, the analysis does not include the cash flow payments beyond the payback period. So, we have said that the payback period refers to the amount of time it takes to recover the cost of an investment or how long it takes for an investor to reach its break even. So, account and fund managers use also the payback period to determine whether to go through with an investment. So, in decision making, the shorter payback means more attractive investments. So, while longer payback periods are less desirable. So, how do we compute for payback period? So, the payback period is the initial investment over the cash flow per year. So, investment and money managers can use the payback period to make quick judgments about their investments. So, as we say here, payback period really is the simplest method that we can use or as we start our business. So, this is an example of the payback period. So let's assume that my company is considering investing 500,000 pesos in two different projects. So we have project A is a retail store and project B is let's say I would like to have a coffee shop. So its cash inflows over the next 7 years are as follows. So, as can be seen, the cumulative cash flows on both investment project turns positive in different years. So, the payback period of project A is little over 4 years, whereas the payback period of project B is a little over 6 years. So, we have seen that in the payback period, typically, these projects with higher gestion period will have a higher payback period than the projects with a lower gestion period. So the payback period really is useful for comparing multiple projects. So the project with the shortest payback period will be the one will I be selecting, which is the project A. So one advantage lang of the payback period method is that it restricts itself evaluating the payback of the initial investment. It does not evaluate the subsequent returns of the profitability of the project. So further, it does not consider the time value of money while accounting for the future cash inflows of the project. But the simple payback period or the payback period really is really helpful for us beginners, for startup companies, because we can identify even on Excel, we will be landing on an faster result. So, following our first method, the simple payback period, we will be now having the discounted payback period. So, the discounted payback period, so kasi diba in the payback period analysis does not take into account the time value of money. So, to correct for the deficiency of that method, the discounted payback period method was created. So, this method discounts the future cash flows back to their present value so the investment and the stream of cash flows can be compared to the same time period. So, each of the cash flow is discounted over the number of years from the time of the cash flow payment to the time of the original investment. So, for example, the first cash flow is discounted over the 1 year and the fifth cash flow is discounted over 5 years. So, the discounted payback period is used as part of the capital budgeting to determine which projects to take on. So, this is also more accurate than the standard payback period or the simple payback period calculation. So, the discounted payback period factors the time value of money. And the discounted payback period formula shows how long it will take to recoup an investment based on observing the present value of the project's projected cash flow. And so, in landing for decision, the shorter a discounted period is, means the sooner a project or investment will generate cash flows to cover the to cover for the initial investment, much like the payback period. So here is an example of the discounted payback period method. So continuing our example in the payback period method, we will calculate the payback period using the discounted payback period method. So the cost of capital here, or our discounting factor, is at 9%. So the payback period for project A, in here we could see that it has increased from 4 years to now 6 years. Whereas for project B, it has increased from 6 years to 7 years. So in here, we could see that how accurate, or the accuracy of the discounted payback period method. While in the payback period method, or the simple payback period method, my project A will recap its investment in just 4 years. But in here, in the discounting or the discounted payback period method, my investment will recap to 6 years. Whereas in my project B, in the payback period method, my investment will just recap in 6 years. But in the discounted payback period method, my investment will recap in over 7 years. So, the disadvantage of ignoring time value of money in the simple payback period method is overcome while using the discounted payback period method. So, other project valuation techniques that consider the time value of money are the net present value and the internal rate of return, which we will be discussing in the next slides. So, what are the differences between the simple payback period method and the discounted payback period method? So, number one, its meaning. So, the simple payback period method calculates the length of time within which the future cash inflows of our project can recover its initial cost, while the discounted payback period method calculates the length of time within which the initial cost of a project will be recovered if the cash inflows are discounted to their present value. So second, the time value of money. The simple payback period method does not consider the time value of money in its calculations, while the discounted payback period method considers the time value of money. So the calculation of net cash inflows. So in simple payback period method, the cash inflows are considered at their future values itself. While in the discounted payback period method, the cash inflows are discounted to their present value by applying the cost of initial, or the cost of capital of the entity. So the other difference in the complexity of calculation. So the simple payback period method is simpler, has a simpler calculation method, while the discounted payback period method is a more complex calculation, as the discounted factor has to be accounted for. So in accuracy, so the simple payback period method is less accurate representation of the break-even point of a company, as it disregards the value of money. So in the discounted payback period method, this is more accurate because we'll be applying the cost of capital. It considers the time value of money. So in weighing in, which is more viable. So the simple payback period method gives equal weightage to the all or to all cash inflows, while the discounted payback period method gives higher weightage to the cash inflows accumulating in earlier years, or vice versa, cash inflows accumulating in later years. And of course, the difference in the result, the payback period results from the simple payback period method will be shorter than the discounted payback period method. This is because the discounted payback period method reduces the value of cash inflows of the project. So, since the discounted payback period method considers discounted cash flows, the project's payback period obtained under this technique will be longer than the simple payback period method. So in here, we can see that while both of these techniques, the simple payback period method and the discounted payback period method, are useful in evaluating projects, the discounted payback period method is preferred due to its higher accuracy. So both these methods, however, consider only the break even of a project. They thus suffer from they have some drawbacks also. These methods do not consider the subsequent cash flows of the projects and thus ignore overall profitability of the project. So while these methods can be used to gauge the initial cost of recovery, they should be used in conjunction with other capital budgeting techniques to evaluate the overall profitability and viability of the projects. The next method in capital budgeting techniques is the net present value. So, the net present value method involves discounting a stream of future cash flows back to the present value. So, the cash flows can be either positive, the cash received, or negative, the cash paid. So, the present value of the initial investment in its full face value because the investment is made at the beginning of the time period. So, the ending cash flow includes any monetary sales value or remaining value of the capital assets at the end of the analysis period. So, if any, so the cash inflows and outflows over the life of the investment are then considered or discounted back to their present values. So, the net present value is the amount by which the present value of the cash inflows exceeds the present value of the cash outflows. So, conversely, so if the present value of the cash outflow exceeds the present value of the cash inflows, the net present value is negative. So, from a different perspective, so a positive net present value means that the rate of return on the capital investment is greater than the discount rate that is used in the analysis. So the discount rate is an integral part of this analysis. The discount rate can represent several different approaches for the company. So for example, it may represent the cost of capital such as the cost of borrowing money to the capital expenditure or the cost of using the capitals or the company's integral funds. So it may represent the rate of return needed to attract outside investment for the capital project, or it may represent the rate of return of the company that can receive from an alternative investment. So, in here, we could see that the net present value or the NPV, this is used to calculate today, the total value today of a future stream of payments. So, if the NPV of a project or investment is positive, it means discounted present value of all future cash flows related to that project or investment will be positive and therefore attractive. So, to calculate NPV or net present value, you need to estimate future cash flows for each period and determine the correct discounted rate. So, in here, we could see its formula where the RT here is the net cash inflow minus the outflow during a single period of time. So, the discount rate here or return that could earn in alternative investments, and the T here is the number of timer periods. So here is an example of the net present value method. So as you can see in our example, the assumption is that an investor or investment will return 10,000 pesos per year over a period of 10 years. And the discounted rate required here is 10%. So in here, the final result is that the value of the investment is worth 61,445 today. It means that a rational investor or an investment would be willing to pay up to 61,445 today to receive 10,000 pesos every year over 10 years. So by paying this price, the investor would receive an internal rate of return of 10%. So by paying anything less than 61,445, the investor would earn an internal rate of return that is greater than 10%. So another method of analyzing capital investments is the internal rate of return. So the internal rate of return is the rate of return from the capital investments. So in other words, the internal rate of return or the IRR is the discounted rate that makes the net present value equal to zero. As with the net present value analysis, the internal rate of return can be compared to a threshold rate of return to determine if an investment should move forward. So the internal rate of return analysis is commonly used in business analysis. So, however, precaution should be noted. It involves the cash surpluses or deficits during the analysis period. So as long as the initial investment is cash outflow and the trailing cash flows are all inflows, the internal rate of return method is accurate. So however, if the trailing cash flows fluctuate between positive and negative cash flows, the positivity exists that multiple internal rate of return may be computed. So in here we could say that the internal rate of return or the IRR is the annual rate of growth an investment is expected to generate, and the IRR is expected or calculated using the same concept as NPV, except that the net present value is equal to zero. So IRR here deals for analyzing capital budgeting projects to understand and compare potential rates of annual return over time. So here is an example of how we will be calculating or how we will use the internal rate of return method for capital budgeting. So let's assume that a company is deciding whether to purchase a new equipment that costs 500,000. So management estimates the life of the new asset to be 4 years and expect it to generate an additional 160,000 of annual profits. So in the fifth year, the company plans to sell the equipment for its salvage value for just 50,000 pesos. So to make the decision, uh, this IRR for investing the equipment is calculated. So in Excel, we used to calculate the IRR of 13%. So using the function equals IRR, close open parenthesis, from a financial standpoint, the company should make the purchase because the IRR is both greater than the hurdle rate and the IRR for the alternative investment. So in here, we could see that the NPV is set to 0 and the IRR is set to 13%. So in here, the company should purchase the machine or equipment because the IRR is both greater than the hurdle rate and the IRR for the alternative investment. Another method that we can use in capital budgeting decision or capital budgeting decision making is the modified internal rate of return or the MIRR method. So another problem with the IRR method that is being discussed earlier is that it assumes that cash flows during the analysis period will be reinvested at the internal rate of return. So, if the internal rate of return is substantially different than the rate at which the cash flows can be reinvested, the result will be or may be different. So, MIRR improves on IRR by assuming that positive cash flows are reinvested at the firm's cost of capital. So, MIRR or the MIRR method is used to rank investments or project of a firm or investor may undertake. So the MIRR is designed to generate one solution and eliminating the issue of multiple IRRs. So in here, MIRR is the discount rate that makes the net present value equal to zero when a reinvestment rate of return is included in the analysis. So the rule for MIRR is to accept investments if the modified internal rate of return is greater than the threshold rate of return, and reject if the modified internal rate of return is less than the threshold rate of return. So here is an example of how we can use MIRR method in capital budgeting decision making. So in here, the analysis of cash flows or the for two projects or two 10,000 peso investment. So the modified internal rate of return for two 10,000 peso investment with annual cash flow of 25 and 3,000 is shown in our example. So the internal rates of return for the projects are 7.9 and 15.2% respectively. However, if we modify the analysis where cash flows are reinvested at 7%, the modified internal rate of return of two projects dropped to 7.5% from 7.9 and 11.5 from 15.2%. So if we further modify the analysis where cash flows are reinvested at 9%, the first modified internal rate of return rises to 8.4 from 7.9, and the second only drops to 12.4 from 15.2. So if the reinvestment rate of return is lower than the internal rate of return, the modified internal rate of return will be lower than the internal rate of return. So the opposite occurs if the reinvestment rate of return is higher than of the internal rate of return. So in this case, in our example, the modified internal rate of return will be higher or is higher than of the internal rate of return. And there we are. We have discussed already the five techniques that can be used in capital budgeting decision making: the payback period method, the discounted payback period method, the net present value method, the internal rate of return method, and the modified internal rate of return method. So, for comparison of the five capital budgeting techniques or methods that we have discussed, two capital investment projects are presented in our example. So, the first is a 300,000 investment that returns 100,000 per year for 5 years. And the other one is a 2 million peso investment that returns 600,000 peso per year for 5 years. So in here we could see that both projects have payback periods well within the 5-year time period. So project A has the shortest payback period of 3 years, and project B is only slightly longer. So when the cash flows are discounted 10% to compute for discounted payback period, the period needed to repay the reinvestment is longer. So project B has a repayment period for over 4 years in length and comes close to consuming the entire cash flows from the 5-year time period. So if we would use this in net present value, project B is 275,000 peso compared to only 79,000 peso for project A. So if only one investment project will be chosen and the funds are limited, the only project that will pursue or project B is the preferred investment because it will increase the value of the company by 275,000. However, project A provides more return for peso investment as shown with the profitability index of 1.2 or 1.26% for project A versus 1.14% for project B. So if funds are limited, project A will be chosen. So both projects have a high internal rate of return, while project A has the highest. So if only one capital project if is accepted, it's project A. Alternatively, the company may accept projects based on a threshold rate of return. So this may involve accepting both or neither of the projects depending on the size of the threshold rate of return. So when the modified internal rate of return are computed, both both rates of return, then their corresponding internal rate of return. However, the rates of the above reinvestment rate of return of 10%, as with the internal rate of return, the project with the higher modified internal rate of return will be selected if only one project is accepted. So, or if the modified rates may be compared to the company's threshold rate of returns to determine which projects will be accepted. So, in conclusion, each of the capital budgeting methods outlined has advantages and disadvantages. So, the payback period is simple and shows the liquidity of the investment, but it doesn't account for the time value of money or the value of cash flows received after the payback period. While the discounted payback period incorporates the time value of money, but it doesn't account for cash flows received after the paycheck period. So the net present value analysis provides a peso denominated present value return from the investment. So, however, it has a little value of comparing investment of different size. So in here, uh, the profitability index is a variation on the net present value analysis that shows the return per peso investment, which is valuable which is valuable for comparing projects. So, however, many analysts prefer to see a percentage return on an investment. For this, the internal rate of return can be computed. So, but the company may not be able to reinvest the internal cash flows of the internal rate of return. Therefore, the MIRR or the modified internal rate of return may be used. So, which capital budgeting method should we use? So, each one has unique advantages and disadvantages, and companies often use all of them. So, but while each one provides a different perspective and the company of the capital investment decision.